can help you make smart trading decisions, because triangles are one of the most reliable chart patterns that you can get. Now, chart patterns are well documented in technical analysis literature and are based on the psychological phenomena that occur between buyers and sellers of financial instruments in liquid markets. Pattern formations do not form a trading system, but rather provide an indication of the future trend of an asset as it breaks key psychological barriers in the form of support and resistance. Well, that was really a mouthful, wasn't it? So I'm sure you've heard about chart patterns and their relation to technical analysis. You probably heard about double tops and double bottoms, triple tops, head and shoulders, rectangles, wedges, cups and saucers, all of these patterns. Now, these patterns tend to appear on our charts in everyday trading sessions on a repeated basis. Now, as you see on your screen, these are what I call, or these are considered the major patterns. There's lots of other patterns people have come up with over the years that either don't stand with the test of time, or there's some guru's little personal thing. I mean, I've seen dragon patterns, I've seen butterflies, I've seen everything. But double bottoms, bull flags, bull pennants, ascending wedges, descending wedges, triple tops, bear flags, bear pennants, inverted head and shoulders, cup and handle, wedges appear all the time. Okay. Now, we can take, I'm just trying to get a marker up here. We can take a look at things like double bottoms and inverted and right side up cup and handle. We can look at head and shoulders. But all in all, most of these I don't pay attention to when trading. Not that they're not valid. In today's type of trading with the fast-moving markets we're looking at, we get lots of double bottoms. We get double bottoms, double tops, triple bottoms, triple tops, and they come and go so fast because today we're trading in these minute little pips. We also, head and shoulders and a cup and handle work very well in stock trading. We hear about them now and then, but they're slow patterns to develop. And when we're trading fast-moving assets and a short-term trading style, we don't have time for all of these to develop and when it's going to affect. Because most of the time you'll see a head and shoulders and inverted cup and handle on 4-hour charts, 6-hour charts, maybe daily charts, and they take a long time to develop. But if we get rid of all of them and we stick to bull pennant, okay, I don't want to forget the bull pennant, but I want to forget these names: descending wedge, bull pennant, ascending wedge, bear pennant, expanding wedge, and we can call all of these triangles. Because a triangle is two sides moving into an apex. Now, there are all types of definitions that give us these different types of triangles. But ultimately, recognizing all these different triangles don't help us. Now, there are very involved, complicated explanations of when we see a bull pennant. A bull pennant is supposed to tell us it's a continuation pattern in the direction of the previous trend. And what happens is we get so involved in the characteristics and the rules that we don't really pay attention to the pattern. The fact is, anytime an asset is moving into to form a pattern, anytime an asset's moving in and you have an upper line and a lower line, which is your support and resistance lines, whether they're symmetrical, whether they're asymmetrical, whether they're ascending, whether they're descending, whether they're in a wedge, you always have a support and a resistance line moving towards an apex. The difference between one triangle to the next is the degree of the angles. like a symmetrical triangle, the upper and the lower line are moving at the same angle degree. An ascending triangle has a horizontal line and an angular line. A descending triangle has the opposite. A wedge has the upper and the lower moving at different angles, but still, they're all still meeting at some point. So they all form what I call triangles. And if you get rid of all these characteristics and these preconceived notions of what is supposed to happen and learn to recognize these patterns, you'll see that they happen quite often on your charts, like you see right here, and that they appear quite often on your charts. And all we need to worry about is what we call the breakout. When we see price moving in a triangular formation, whether it's an ascending, a descending, okay, when we see price moving in an angular formation, we know that it's going to get pent up demand. Okay, and it's sooner or later it's going to break out of that triangle. Okay. When it breaks out, it can break out upwards or it can break out downwards. There is no rule, there is no guarantee, there is no nothing about which way it will break. Now, like I said, there are all of these characteristics that are supposed to tell you something, but in essence, they don't. So if you get them out of your head and say, when I see a triangular pattern and it breaks out of that and the price breaks out of that triangle, how do I know whether I have a false breakout or a real breakout? And how do I know how to trade that? So that's what we want to talk about, because all triangles have certain characteristics or certain definitions that work together. The width of the base of this triangle will help you set the target point for where the price should move to when it breaks out. Now, whether it breaks out upward or downward, price should move to that distance, equal distance to its base. Well, that helps you when you got to set your risk-reward ratio. Where you set your stop loss is also critical based on the triangle, and what you would use to verify the breakout and where you would put your entry point. All of these are very important pieces of information you have to have to determine whether you can trade that breakout or not. So, like I said, if we take the head and shoulders pattern, the double tops, double bottoms, triple bottoms, the consolidation, the pennants, the flags, the rising wedges and falling wedges, and only look at what we call triangular patterns, we can make our trading life easy, and we can use these triangles to find very high probability trades. So in order to have a complete understanding of chart pattern trading, we should also gain a good understanding of one of the most common ARN chart formations. What I'm referring to are triangle trading patterns. So in this webinar, we're going to discuss triangle formations and the ways to properly identify them. Now, the triangle pattern is a specific figure formed on a price chart, typically identified when the tops and the bottoms of price action are moving towards each other like the sides of a triangle. When the upper and the lower level of a triangle interact, traders expect an eventual breakout of that triangle. As such, many breakout traders use triangle formations to identify breakout entry points. Now, there are different kinds of triangles that can be seen on a price chart. And as I've shown you, we don't need to separate them. You can know that we have a symmetrical triangle. But what we do know is that we need to measure the distance of the base, and then we can drop it on at the breakout up or down, and then determine the limit of, or the, how far our trade should move. Okay. Again, we don't want to get involved in the character of the triangle. We don't really care whether it is a continuation pattern. We don't care whether it's a reversal pattern. Because nothing makes a difference until the breakout happens. So the directional breakout is unknown. And the reason for this is that the bullish and the bearish move have equal strength as seen through price action. Until the breakout, we can't figure out anything. When a breakout eventually occurs, it's likely to provoke a move equal size to the base of the pattern. Therefore, you should carefully identify a potential breakout in the upper and lower levels of this triangle in order to take the right position in the market. As you can see from the example, the potential target is based on the size of the triangle formation. With this type of measured move analysis, you will know what to expect when the triangle breaks out. And again, we have ascending triangles and descending triangles. Okay. Same rules hold true whether it's an ascending, a descending, a symmetrical. And ascending and descending are mirror patterns of each other. These types of triangles have one flat horizontal side and one sloping side. But again, we have to wait for the breakout and then measure the width of the triangle, and then use our chart patterns and our candlestick patterns to find out our entry point and our stop loss level. So it's very important to mention that the ascending and descending triangles sometimes break through the incline level, causing false signals and trapping some traders along the way. You should always wait for the close of the candle to confirm the breakout. Now, my rule of thumb is when price breaks out of the triangle, you need a second candle as a confirmation candle, because you need to wait for that breakout candle to close and make sure it closes outside of the pattern. And then the next candle must stay outside of the triangle also. The next candle moves back into that triangle, you had a false signal. If that pattern, if the next candle stays outside of the triangle, you would use the close of the breakout candle as your entry point, and you would use the swing low of the last candle inside as your stop loss point. So what do we have? We have symmetrical triangles, we have rising wedges, we have bearish pennants, we have increasing expanding triangles, but they're all triangular patterns. So when we have seen the triangle pattern, we have to wait for the breakout. Once we get the breakout, we can use the swing low to set our stop loss and the close of the breakout candle to set our buy. And then we would use the width of the triangle to set our stop loss. But we can't actually make a trade until we have the next candle staying outside of the pattern, and then we would enter the trade at the close of the breakout candle. So in other words, here we have the breakout. We would put our stop loss right below the swing low of the lowest candle prior to the breakout. We would set our entry point based on the open of this candle and our limit order based on the width of the triangle. But in this case, it's because we had a second bullish candle, a bearish candle, but the entry point should have technically been set here. So this candle closed here. This one fell and closed down here. So we wouldn't have entered until the third candle. Now, there are some cues that you have to see, and we'll talk about them in a minute, to make sure that you actually have a good pattern. So again, here you can see stop loss here, limit order here based on the width of the target. The entry point would be on this candle based on the height of the breakout candle, and you would enter here. In the opposite movement, when it's a downtrend and breaking out downward, you do just the exact opposite. Now, you'll read in all the literature about, like I said, all the characteristics. If you see an ascending triangle, it should be a bullish continuation in the movement of the prior trend at this level. There's no guarantee. False breakouts happen, retests of support and resistance happen, and until the price breaks out, you have no information. But the fact is, we've gone and measured and done a study of if you stuck with that characteristic of what the triangle is supposed to be telling you, how often is it right? It was only correct if you followed the characters 42%, 52% of the time. That's not enough odds for me to waste my time dealing about characteristics. My time is better spent waiting for that breakout. So the easiest way to trade this chart pattern is to treat it as a continuation breakout. Here, just wait for a clear breakout above the resistance and the bullish line. Okay, that's what people say. But it's only 52% of the time it's going to be correct. I need a lot more than that. So we increase our success rate by first thing is, when a triangle appears, rating the quality of the trend pattern when it appears is very important. The more well-developed the chart pattern, the more well-developed the trend is, the more reliable the breakout is going to be. We want to look at the secret weapon, because all of that sounded really easy to do. But unless volume confirms the breakout and confirms the direction of the move, you can't make this trade. Okay. So as a triangle extends and the trading range contracts, volume should start to diminish. So as it moves into the center of the triangle, the apex, volume should dip. This is referred to as the quiet before the storm, or the tightening consolidation before the breakout. Once we have a breakout that is qualified, then we should see an increase in volume. If we don't see that correlating increase in volume, the trade is not a valid trade. Now, remember, breakout direction. The future direction of breakout can only be determined after the break has occurred. Sounds obvious enough, but attempting to guess the direction of breakout can be dangerous. Even though a continuation pattern is supposed to break out in the direction of the long-term trend, this is not always the case. A break should be on the closing basis for it to be considered valid. Now, keep in mind that a lot of times you have a breakout, but it's a false breakout. It'll return back into the apex. Now, to set the price target, it's the widest distance of the angular lines forming the triangle. So to sum it up, triangle patterns are easy to spot and provide good risk-reward opportunities. Traders can quickly know that a big move may be near, as well as the profit objective and the amount to be put at risk. Now that you have the knowledge of the three powerful price patterns, you are steps closer to becoming a more confident trader. And if you'd like to learn more, just sign up for more classes at justlearnacademy.com. I'm sorry, justlearn.academy, no .com. And enroll in all of our free classes. Thank you very much for joining us today, and good luck.